Let's get started.
You're
Good morning,
late 10
everyone,
minutes.
and welcome back. Asset Plus has another interesting session for you, along with, of course, Mr. Sunil Subramaniam, to help all of us stay updated on what's happening in the industry. Over the last week, many of you would have seen the news around SEBI's new changes on the TER for mutual funds. There is a lot being discussed, and we know it can feel confusing or too technical when information comes in bits and pieces, right? So today's session is aimed at keeping things simple to understand what the new changes are, why these changes are being made, and what its impact would be going forward. No jargon, just clarity for you. And of course, there's no one better to take us through this than Mr. Sinha, given his deep understanding of the industry and the regulatory environment as such. With that, I'll hand it over to Sunil to walk us through the key updates. Sunil, over to you.
Thank you, Anu. And if you can move to the first slide. So why are we discussing this today? Because SEBI has launched a consultation paper with some proposed changes. Now, this consultation paper is out in the public domain for all the impacted people to respond. So it's not the final word, first, number one. There is a timeline of November 17th given to submit your responses written or online through SEBI website to SEBI. SEBI will review those and in my estimate may take it to a December or January board meeting of SEBI, and most likely the changes after they have evaluated the feedback will get implemented from the new financial year. So first thing is that none of this is immediate. Second is none of this is final. Okay, so keep those two clauses in mind, that it's just a proposal, but it gives you a clear view into SEBI's thinking, which is important to understand. There may be a few minor changes here or there, but conceptually, SEBI is just laying out its thought process. And so let's try and understand that. And based on the current proposals there, try to evaluate these changes proposed from the three lenses, right? First is from an investor lens and their costs. Second is from an investor lens, but on terms of transparency. And third is, since all of you are either existing MFDs or wannabe MFDs, what is going to be the impact of this on distributor commissions? So let's stay on this slide because I have only a few slides today because some of the crunch points, the entire consultation paper is very long, and I'm not going to discuss a lot of things which are overall in the interest of the industry's growth, industry's regulation and transparency. So those I have removed out. So only a few I have taken here. But before I just step into that, I think a little bit of an introduction on what is the SEBI thought process and why at all a change proposed at this point. So first is that issue is around the costs. So customers are currently charged a mandated cost by SEBI, and the main thought process of SEBI is that customer costs should be kept minimal, right? Because end of the day, it comes from the return to the customer. So they are attempting to minimize the cost to the customer, number one. Number two, in that process, what they have been seeking to do for quite some time, and it's not just this consultation paper, but a series of their regulatory reforms over a period of time have been oriented towards, in the cost domain, to pass on the economies of scale of the industry. So the broad cost structure that was already prevalent and currently prevalent has been broadly, I would say, laid down when the industry was much smaller in size, maybe even at 25 lakh crore, right? So since then, the industry has now tripled in size. So there is a thought process in SEBI's mind that the industry has tripled in size. The benefits of that scale must percolate down to the investor. So with the view in mind, they quite some years ago introduced a reverse scaling mechanism for the expense ratios charged to investors. What is the reverse scaling mechanism? That for a smaller funds, you start off with a reasonably comfortable expense ratio. And then as each fund grows in size, the expenses chargeable to the fund keep coming down. So it starts at about 2.5 at a very small fund size for equity schemes. And at about 50,000 crores, it comes down to about 1.05%, the existing structure. So as you can see, almost 150 basis points is the scale benefit that SEBI is already mandated and already implemented in terms of passing on costs to the investor. Now, this consultation paper is trying to take that one step forward. That's one, right? But the big step of the reverse cascading mechanism I spoke has already been in years for a number of years, and it's a clear indicator of SEBI's thing. We'll come down to the specifics here. The second issue is about transparency. And let me first address the issue on cost transparency itself, right? So the existing expense ratios are commonly known by a word or a abbreviation called TER. You ask me for the expansion of TER, it purports to be total expense ratio, but it is a misnomer. Why? This is an expense ratio, but it's far from being total. The reason for that is, as I said, from 2.5 down to 1.05 was the reverse cascading mechanism, but fund houses were permitted to charge something over and above TER. Now, when you say about the total, it's definitely not right. It could be a subtotal at best, right? So first of all, this word TER was a misnomer. The first thing SEBI is proposing with the new consultation paper is to revise that definition of TER and calling it a BER. What is that? That's a base expense ratio, thereby communicating that this is the base and there are going to be costs to the investor over and above that. And so the limits that I said are essentially of the base expense ratio and not of a TER in the new context. So first thing, bear in mind. So what then? Is there a TER? There is a TER, but the TER is not specified by SEBI, because what is going to be outside of the BER plus X expenses which SEBI is going to allow are going to be at the not at the control of the fund house, but at, say, things like taxes and other things. So the investor will have a total expense ratio, but that's an uncontrollable. It's in the hands of government authorities and others. So that's the first point. So there will be a total TER, but that's the base TER plus regulatory costs, if I may say broadly. That's the thing. So that's where the SEBI wants to bring the transparency, because the investor could question. You said to TER total was this, but my statement shows something plus that. Then how is it a TER? So it was clearly somewhat gray and cloudy and not clear. So the transparency was being brought in this consultation paper, right? On distributor commissions, we will talk about it when we talk about this, but the two fundamental things are passing on cost savings and being transparent about what is being done. This is the thought process behind the consultation paper, which has this impact on distributor commissions. So we will come to that later. Now, what is the first change that SEBI has proposed? The first change they have proposed is that historically, a little bit of history is needed here. Investors were charged exit loads from schemes in order to prevent them from taking a very short-term call on their investments, because that in turn would force the fund managers to sell stocks that they didn't intend to sell. If suddenly a big investor comes and redeems money, and then you are making a 3 to 5 year based outlook based investment, but the investor is taking his money out within 3 months, you're forced to sell that. And the market situation may be that you'll force to incur a loss. So the original rule was the fund managers and the asset managers were permitted to charge exit loads to prevent these kind of a short-term behavior by certain investors. Then SEBI came up and said that no, because what is happening is that this was going straight to the AMC's profits, the thing. And SEBI said, no, it's a deterrent to the scheme. So I'm not going to allow you to take these exit loads into your earnings, but credit it back to the scheme. Because when you then put an exit load and still an investor exits, right, the cost of early selling of a share or a security could mean a loss, but that loss is being borne by the investor, not by the AMC. So why are you taking the money to yourself, credit it back to the scheme? So some years back, SEBI had already made that change. But when they made that change, they realized that the asset management company was also probably suffering in terms of their decision making. So they allowed this total TER, which was the earlier TER, another 5 bps on top of the TR. That's why I said the TR became meaningless in terms of total. So extra 5 bps was allowed since 2018 because the change was made that exit loads, instead of going to the asset manager, were going into the schemes concerned, right? So SEBI's whole perspective was, I gave it for a short period for you all to adjust to this new mechanism and pre-prepared that there may be some early exits, and accordingly, change your portfolio to create that liquidity so that you don't have to sell a long-term intended holding stock, but you can sell something from a more liquid portion of your portfolio. And over the next, whatever, now it's been 7 years since this was been introduced, they said now the industry should have adjusted to this. So this additional 5 bps, I'm taking it away. That's the thought process. Now, clearly, two things are there. This 5 bps reduction will most probably mean straight away a distributor commission reduction by 5 bps, because from an AMC's perspective, we will say nothing's changed for me. Why should I, take the hit? So most likely, this drop of 5 bps in the expense ratio will be passed on to distributors. But like I said, that's still a decision, and AMC could choose not to do that and absorb it. But in the thought process, since SEBI realizes that earlier 2018, those AMCs which were there, their scheme sizes also had grown in size, so their ability to absorb this kind of a thing is much higher. But newer AMCs with smaller funds, right, may still face a little bit. So SEBI has also clearly stated that for smaller size, the first two slabs of the schemes, right, they will not allow this 5 bps to be cut. Instead, the base TER will be increased by this 5 bps for smaller schemes. So the first slab, which is about 500 crores, and the next at 750 crores, will carry. Unfortunately, there was a typographical error, and later when we show you a slide where the expense ratios come, those first two slabs don't show this SEBI's intention. I'm sure it is just a typographical error, and when the regulations are finally passed, you will see that those smaller schemes will have their expense ratio increased by this 5 bps, so that they still get that cushion in terms of the thing. So in that case, then those who are selling the smaller schemes in the distributors may not face a reduction in their commission here. Okay, like I said, this is just an understanding and reading. Now, remaining on this slide, I want to move to transparency. Okay, so what I want to say about transparency is that, so first was that the word TER was wrong. They've addressed that issue by using the word now BER and then saying plus X. The second issue on this transparency comes in is that some of the expenses from a taxes perspective earlier were charged within the scheme and some were charged outside of the scheme. So SEBI now wants to be clear that all statutory government taxes and those kind of levies will be outside the base expense ratio. So that's the second thing the consultation paper proposes, is that all taxes and statutory levies will be outside of the base expense ratio. Okay, so that's an important point. The second point on the action here is that in terms of the impact on things which are outside of the TER, which is where they were trying to bring down the cost aspect, there's one more thing which was earlier outside of the TER, which was the brokerage charges. So if we may now move to the next slide, we will talk about the brokerage charges. Sorry, I think we've already come to this. I'll come back to this slide later, Anu, if I can move to the brokerage slide, please. The next one. Yes. Let me explain this. So this brokerage charge, what is this brokerage? Very often, especially those who are MFDs newly entering, there is some confusion in terms of the word brokerage used. Okay. So actually, in reality, there is no, but because of the common lingo, people, MFDs who are selling schemes and get commissions, trail commissions, refer to that as brokerage from the AMCs. Now, it's very difficult to go and change their mindset, but I want to clarify that throughout this presentation or in SEBI's proposals or anywhere in the world, the word brokerage refers only to that paid to stockbrokers. That's why the word brokerage. Do not use the term brokerage for your commissions. You refer to them as commissions or as trail commissions. So let's be clear. So this brokerage charge is not directly connected to MFDs, but there is an indirect connection to which I will come. But this brokerage charge reduction comes with two components to it. First is the cost reduction component. Second is the transparency component. As I said earlier, the expenses outside the thing were given a lot of leeway, right? Because of various reasons, right? They're not in their control. So SEBI is now coming to bring clarity, and on the brokerage, they want to do two things: transparency and cost reduction. So what is the existing rule? So what is this brokerage charge? Let me further explain it to you. It is that when a mutual fund scheme, through its fund manager, buys or sells stocks in the stock market or debt securities in the debt capital markets, they do not do it directly. They do it through an intermediary called a broker. Broker is a short form of stockbroker. Okay. So when you then say, I give the transaction, the broker has a job of executing the trade. So fund manager comes to work in the morning, feels that X share he wants to sell. So he calls up the broker, either it's through an online terminal or it's through a telephone, depending on what it is. In debt, is still a phone-based system. In equities, it has all moved to a straight-through processing transaction where you put in a sell order or a buy order to the broker to say that I would like to buy X company share. Currently, it may be trading at 100, but I'd like to buy it if it comes at 90. So you set a price limit. Or you want to say you want to sell. Currently, it's selling at 100, but if the price hits 110, I'd like to sell. These are all just hypothetical examples. So the broker's job is then to execute that transaction. He goes out and looks at other counterparties. It may be his own customers of other AMCs. It may be insurance companies. It may be retail traders. It could be FIIs. Could be anybody. He keeps a watch and a track. And when that price somebody is willing to accept, the trade gets executed. Right? So that's the job of execution. Now, clearly, in this aspect, mere execution does happen a lot, especially when AMCs are dealing with what is called the arbitrage component, which is derivatives, F&O, right? They are permitted on a fully hedged basis to take part in covered shorts and use derivatives for hedging their portfolios. Those kind of trades obviously are only execution purely, and hence SEBI had set a limit earlier that up to 5 basis points for derivative trades, you can charge the investor outside of the TER. So the first thing was that shows you that the TER was no longer total. So whatever the AMC paid up to 5 basis points for a derivative trade was slapped on to the TER and charged to the customer. Next, we come to the fact that stockbrokers are not mechanically pass-through agents. Then a computer could do easily this. There is one person to speak. No, stockbrokers are also known as sell-side brokers or sell-side analysts, which means that they give advice to the AMCs on buying and selling stocks. They have research teams at the back end which study this, and these are highly qualified people. Most of them are engineer MBAs, especially from the creme de creme institutions in the country, like the IITs and the IIMs. So they are highly paid people who do quality research in terms of the stocks, and they track the economy, they track the sectors, and then they track the companies, and then they say that this company, we recommend a buy or a sell. And when they say buy or a sell, they also say this is the target price. Because once you reach the target price, we will revise our recommendation. But right now, we feel there's an upside to that target, or there's a target downside if they feel there's negative. So they give two-way opinions based on which the fund managers and the analysts. So naturally, there's a lot more work involved. So SEBI has allowed for those kind of trades, non-derivative trades, up to 12 basis points to be charged outside the scheme. So clearly, from an investor perspective, two AMCs, we have the same type of funds in the same size category, but his expense ratio from AMC could be very different from B. Why? Because in AMC, I'm using a lot more of broker research and less of my own research, because all AMCs, fund managers have their own analysts and they also are supposed to do research. The thing is that with about more than 4,000 or 5,000 companies, the stock market is physically impossible for each AMC to cover so many, right? And so they rely on the sell side, okay? But the key point here is that AMC could be buying and selling very actively. B could be by and large having a buy and hold approach. So the two brokerage costs would be dramatically different. The fund size is the same. So investors would question to say, both are 25,000 crore fund size. In this one, my expense is X. In that one, it is only Y. Why the difference? So lack of transparency because of that. So now SEBI, with a view to both to reducing costs. Now, where does the cost reduction issue come? First is what they've already studied in terms of what they find as practically what are people paying. So, for example, in the AMC universe, SEBI has found that for brokerage, for arbitrage, that is derivatives trades, AMC is paying 1 to 2 basis points, whereas they allowed a limit of 5. So they're saying, so why should we have an excess limit? We'll bring it down. That's one. Similarly, in the other case, on the up to 12 basis points, it varies from AM to AMC. There is a weighted average, which is probably around 5 to 7. But there SEBI says, look, I feel there's been a duplication of charge. Because the AMC has its own research team and supposed to do research. They are being paid a asset management fee for the thing. Now you're paying this broker also a research fee, which means that you broker pays a research fee, you are also charging a research fee. There's a double expense to the customer, right? So SEBI says, why should that be? I'm already permitting to you. So what they have done is they have brought that 12 also down to 2 basis points. Okay. And they said, outside of the base expense ratio, you will now be allowed to charge only 2 basis points for your trades. Now, naturally, this is a big step, because that's 10 basis points drop. So who is up in arms? Well, the broking community, for example, who are also regulated by SEBI. They're telling SEBI, look, we have been providing support at 2 basis points. There's no way on earth I can afford any quality analysts and provide any of this. So you are doing the death knell for our business. But within the count, there is a clarification where SEBI has said that if you want to charge more than 2, do it within the scheme so that there is no double counting. So suppose I want to pay a broker 5 instead of the 2, which is allowed outside the scheme, that extra 3 I should take within the scheme. What are the implications of that? If it comes within the scheme, then my AMC fee has to come down, with the scheme-based expense ratio is limited. And the impact for distributors there is that the AMCs may choose saying, no, why should I give up my fee? I'll cut the distributors' trail commissions even more, potentially, right? So this is the implication of this. Still, the stockbrokers have gone to SEBI and said, AMCs, because this coming from their fees, will now negotiate that much harder, but that could end up making our business unviable. So please relocate it. So the broking community, I'm sure, will by November 17th be writing to SEBI to say, relax this. So SEBI has also, in a kind of, I think, public domain, stated that they are re-looking at this limit. So let's wait and see. But conceptually, this is a function of both cost cutting as well as transparency, and which has a relative impact on the distributors. And naturally, earlier, the high churn was impacting the investors in terms of the brokerage cost being added. Now that high churn will increase the impact within, because the higher churn means I may pay 7 instead of 5, and that will again come at either AMC cost or a. So what I'm trying to say is that in this negotiated dialogue between distributors and the AMC on the commissions, this is another factor that the AMCs will have in their mind, saying that I would like to reduce distributor commissions to protect their management fee. And especially Naturally, this is of much greater impact for listed AMCs because they have quarterly earnings forecasts, they have to give guidance. So naturally, there the pressure to maintain their revenue because the stock price of the company is at stake, whereas a non-listed AMC could have a little more leeway. But like I said, these are just hypothetical. So this is an important change, which was both from the transparency side and from the other side. Now, I had mentioned that, let's stay on this slide, no? I want to talk about the next aspect is that now, so far from what I have said, distributor commissions will get affected by 5 basis points due to the removal of the 5 basis points in lieu of exit load. Second, distributor commissions could affected because of the brokerage charges, which AMCs may pay more than the 2 basis points, might come at some cost may have been passed on to tail commissions. Now, SEBI in the chart, so now if I can go to the chart, see, has reduced the TER. My don't have a before and after here, right? So this is the new one. But those who are familiar with the before will know that across the board there is a 15 basis points cut. So naturally, that's a further direct impact on your commissions. Now, SEBI said, I want to remove that 5. Why is there a 15 basis points cut here? So, which actually translates to 20 basis points cut. No, because there's a 5 basis points cut in the TR, and then on the TR itself, you're cutting 15. What is the logic for this? Now, this again is a function of transparency plus cost reduction. So, let me again explain this to you. And it's not as bad as it looks at the outside. I'll explain that also. So what did I say on the transparency part a few minutes ago is that SEBI has now defined a base expense ratio and said all statutory levies should go outside, right? Now, the old rule was that only for asset management fees, the statutory GST levy was outside of the TER. So in addition to brokerage up to 12 basis points or 5 basis points being outside, the AMC's asset management fees was already permitted to be outside. But there's a lot of other expenses which are paid within the scheme's expense ratio on which there could be GST, but they were not permitted to be outside. So SEBI has taken a very bold decision now that all such expenses which incur taxes, including the brokerage which incurs GST, right? This would now be outside the base TER, right? So then you'll realize now the base TER is no longer total TER because now the base TER carries base TER, base ER, base expense ratio plus the 2 basis points of brokerage plus the GST on the 2 basis points, which is outside. It will contain the asset management fees plus the GST charges. And if an AMC chooses to pay brokerage within the scheme, that is the difference between 2 and 5 or 7 or 12, whatever they choose to pay, that difference carries a GST. That GST will be also outside, right? And the fourth is there are other expenses like R&D commission, the registrar and transfer agency like CAMS and KFinTech who do that work. They also pay, there is a GST. So that's currently within. That also is now permitted to be outside. And distributor commissions, trail commissions, they also, so currently they are not being allowed to get a GST credit for the trail commission they receive. So because that is paid from within the scheme itself, right? And hence, what SEBI is saying is now that entire expenses that are paid within a base expense ratio, any taxes implication of that will be outside of the base TER, right? So obviously, the total expense ratio will now completely, vary depending on the various costs in the expense ratio. So, but there is a clarity of transparency here that the base expense ratio is fixed Within that, there are 3 components or 4, multiple components are there, but all of those components, taxes, will be outside of the TER. So the new rule is that it's base expense ratio plus statutory levies plus up to 2 basis points for brokerage. That's the thing which is going to be outside compared to the old. Now, if that happens, right, if you're going to remove those expenses from charging to the scheme, then why does the scheme need those higher TERs? So, because they are moving the tax component outside, they have reduced the old TER to the base expense ratio now by 15 basis points across the board. Right? So, naturally, this reduction of 15 basis points will impact trail commissions. Right? But what is the flip side and the advantage? Which, if you go to the next slide, after the 2 TER, this is the TER for the active funds, this is the TER for FOFs and the passive funds. Next. Right? This also next, we've already covered. This we have just covered. So I've written a potential win for MFDs. So let's go back to that. I'll explain the win. So while your trail commission, because of this, will come down on an average by 15 basis points, it has to come down because AMCs are not going to accept a reduction in their expense in their management fees because they have a lot of fixed costs in their thing in terms of the salaries of the fund managers, salaries of the salespeople, the cost for a Bloomberg terminal, the cost for the offices, the cost for electricity, all these are fixed. So there will be very limited ability of an AMC to accept a reduction in their management fee. Hence, this will be mostly passed on. But along with it, though I am not the right person at this point in time to assure you that this will happen, but the potential exists for the trail commissions to be paid as X trail commission, lower than before, but with GST. That GST will be charged to the customer outside the base expense ratio, right? And so for you instead of getting your old trail commission as a flat one, you will get it as a breakup of base distributor commission plus GST. And once it's then paid to the GST authorities as GST on your behalf, or you pay it, or I don't know how the mechanism is going to work, you can set off your expenses against that GST, that input tax credit you can gain. So to that extent, it's a huge win, because I know since my time that I have been with the AMC for about over a decade, it has been a very pressing point among very distributors saying, so we are actually suffering almost 50% tax. Why? Because some of them who are in the income tax bracket of 30% plus GST of 18%, 48% is the tax on my revenue. So why can't the AMC's hands were tied because it's all within the expense ratio and there is no credit available there. So now with this clarification, right, hopefully distributor trail commissions will now come as base plus GST. The accounting and the credit will go to the GST authority so that when you file, you can claim those claimable expenses against that GST as input tax credit. And this could be potentially a big win. Now, so simply to explain, if you are at a 1% trail commission, right, it will definitely go down by 5 to 95 basis points because of the further, it will go down by another 15 basis points, and maybe it will now come down to 80, assume the worst case scenario, or whatever. I can't say worst case also because different AMCs could pass it on in different ways. I don't know how that's going to work out. But let's say you're getting 80 now, but with that 80, they will give you now 80 plus 18% of 80 as GST because it's outside of the expense ratio, right? So when you get that 80, now earlier when you were getting 100, 1%, what was happening? That 1% was coming to you and 30% was going as income tax and 18% was going as GST, gone as GST there. So you effectively got a 48% cut of that. Now, to that at the 18, that full 18 is also not a cost for you because you can set off certain expenses against that 18. So you'll get 80 plus whatever you are able to set off as your net revenue on which you'll pay income tax, right? So I just gave you a broad macro explanation of the mathematics. Individually, each one of you will have to work out. The AMCs will have to come back and explain all of this. I'm not getting into the mechanics of it. I'm just going to give you a bird's eye view of the fact that what is taken away by one hand is probably at least partially compensated by another through this whole SEBI move, right? So I'm not saying that you will be fully protected. There will be impacts. And so from that point of view, and what I'm saying is that your whatever the dip that you see in a gross trail commission, don't get reactive to that because of the GST impact and the post GST, it won't be as painful to that extent. But that being said, there is definitely going to be a reduction in brokerage almost and defense. So naturally the size then matters, right? When we all negotiate, when you go to a local vegetable shop, if you go to the wholesale shop, right, you'll say, I'll buy 2.5 kilos of vegetable and give me a better price, right? So scale is always a good bargaining tool. So naturally, those distributors who are committing a lot of AUM to a particular AMC will be in a better bargaining position compared to a smaller distributor. So to come to the way forward, then the next slide, right? So to summarize what I said, SEBI is moving MFD to industry to a transparency plus fairness plus efficiency, right? Efficiency in terms of scale coming through, fairness that now taxes and levies are kept outside, and transparency, basically to be very clear about what is being charged is no longer called a total expense ratio, but only being called a base expense ratio. And why it's favorable to investors, the transparency also is because, as we know, the government took a major step in reducing GST across a number of items announced on the Independence Day speech by the Prime Minister. This set of 18% was not affected. But as the government goes through, because what is the government doing? The government is giving the benefits of that scale. From when GST was launched to now, the collections have grown, so they are well comfortable to reduce the taxes. The next step could be this 18% slab being revised to 12, in which case, or 5, or whatever I'm saying. But when that happens, the investor will straight away benefit. Whereas earlier, in the older system, even if that change happened, to the extent of a lot of expenses which were charged within the scheme, the investor would not have got the benefit of a GST reduction. So it is also in favor of investors that any future drop in the GST is also going to be directly beneficial to the investors. Yes, that's one. Second block here says MFD who adapt early will benefit. So what is this adaptation? The adaptation is to obviously think more and deeper about your growing your business by dipping more into the scale. Adapt means that if there are good quality, smaller schemes which see a lesser impact, but which have a good performance track record, stroke performance expectation, you can, in your asset allocation, take that factor into consideration from your, every transaction, every deal has to be a win-win, right? Customer wins by getting a good wealth creation, but you also have a family to run and everything. So adapt to the new dynamics is all I will say. And naturally, as the industry scales up, costs are going to compress. This is only one more step. So in a few years from now, SEBI could again say the industry has gone from 75 lakh crore to 125 lakh crore. It needs a further. So costs will continue to compress. So as an MFD for you, do not underestimate the importance of scale. Scale A, to protect your absolute profits so that you can take care of your family. Scale B, that you can negotiate better with the AMCs for a better trail commission. Right? With that, I end my talk here. Hope you found it useful and I gave some clarity to you on what is still a consultation paper. Like I said, until SEBI holds a board and then comes out with the final circular, we will definitely come back to you at that time again to tell you. So this is what we had earlier discussed. This is the black and white now. And so these are the likely implications. Right? Thank you. And if there are any questions and queries, let's take those.
Sure, Sunil. Thank you for that. The first question that we... Sunil, can you hear me?
Yes.
Okay. So first question that we have is, this charge is for investing in the fund for trading shares. So is it the same for everyone, whether it is a direct plan or a regular plan? So why is there talk of deducting the distributor's commission?
No, I did not say that distributor commission is a given, right? I'm saying that the AMCs, when they look at their profitability, even in the direct plan, when they are whatever they are trading, now the additional cost over 2 basis points has to be absorbed by a scheme expense ratio. Now, AMC will say, why should I take the hit? I have to grow also. So overall, in an indirect way, it get passed on to distributor commission. So they will never come and tell you that, oh, the brokerage charges have been limited to this, so I'm reducing your trade commission. It's overall a package thing. I agree that there is no direct correlation between trading shares and a distributor commission. But end of the day, an AMC will also say, "Mere ko bhi dhanda chalana hai. I have to also got a fixed cost. I can't take the hit. So overall, this is all the brokerage commissions, trail commissions I can afford to pay." So that's the way it comes across. Don't draw a direct connection between that and this. There isn't.
We have one more question where somebody is asking if the trail commission may reduce or not.
Trail commission should reduce. If the expense ratio reduces, trail commission will reduce. I mean, it's a straightaway correlation, right? Because why would an AMC accept all the reduction in expense ratio in his management fees? He will naturally pass it on to distributors, and different distributors will get a different drop in trade commission based on the scale that they have.
Got it. And looking for a little bit of motivation from you, Sunil, we have somebody saying more funds are needed to scale. Every few years, 2 new rules are introduced and distributors' commissions are cut. So how do we scale when we have lower and lower income? Looking for some motivation from you.
No, I think that you have to look at it this way, right? There are two things, right? Profits and profitability. So what you get as a trail commission as a percentage of the thing, right? X basis points, Y basis points is profitability. But profitability into quantity, which is number of investors or the value of the AUM, is profits. So what you should focus on in profits and not on profitability, right? Because like I said, the expense ratio earlier, before the categorization of this reverse cascading came into effect, AMCs were able to charge 2.25% on 1 lakh crore fund also. For them, there's a dramatic drop from 2.25 to 1. But have you seen any AMC's absolute profits go down? No, because the business has expanded. So everybody's focus has to be on absolute profits. So if your profitability, that is the percentage bips, is coming down, you compensate it by two things. One is deepen your share of the customer's wallet. If you look at India's mutual fund penetration is just 17% of GDP. If you look at customers' allocation, out of 140 crore customers, 5.5 crore have. But if you look at allocation of customers, 60% of customers' money goes into assured return, risk, low return products. So it's up to us as industry to go and convince them. And it's not that the industry only has high risk, high reward products. Industry has debt funds and hybrid funds, which are much lower on the risk reward. So penetrating greater into the customer's wallet. There's a huge scope for growth because you're only cross-selling another product to an existing customer. So, but are we making efforts to market those low commission products? Because obviously hybrid funds or debt funds don't charge the same expense ratio as equity funds. So naturally, everybody earns lesser there, but the volume, because people put more money, are willing to put more money in low risk products, right? So deepening the customer's wallet, share of wallet has got to be a key focus for each one of you, because it starts at home. You already have a customer base. Go and see what he gets, what his earnings, what he's got, assess it, and then probate it and get that money. Because the other thing which people are doing is excessive focus on fixed assets, gold and real estate. Yes, gold has delivered a fabulous return in the last year, but that means that their now allocation of gold in their portfolio has gone up even more. So in the interest of asset allocation and diversification, you have to make greater inroads into that. That's number. Second, as I mentioned, there's only 5.5 crore unique PANs in this 140 crore population who are investing in mutual funds. So you have 135 crore people out there who have not looked at mutual funds. So even if you target 10% of those, that's 13 crore, which would take our industry 2.5 times the size it is. Right? So I think that focus on scale. Don't worry about the the trail commission percentages, as the industry scales up, they will go on coming down, because the regulator is clear that economies of scale have to be passed on to the investor. So both the AMCs and the distributors will take lower AMC management fee as well as the distributorial commission. The only way then to keep it, and the industry has done that very well. We had only 3 crore investors during COVID. We've shown a 60% rise to 5.5 crores now. So growth is there waiting for you to grab it. So I would say, don't focus so much on the trail commission part and that my profitability is coming down, but look at how much have I penetrated to my existing customers' wallet today? How much new customers have I touched today? That's the step-by-step progress by which you will progress. And as a result of your efforts, the industry will also progress.
Thank you, Sunil. I think there are a few questions from very new MFDs about how the industry and the business works. For those who asked those questions, we will come back with one more session where we decode what it takes to be an MFD as such. So we'll cover those questions in the next session. Today, if there's any other questions, please drop it in. But thank you so much, Sunil, for decoding SEBI's latest proposal as such. I think this is very useful to understand from both an investor standpoint and as to what it means for an MFD themselves. So thank you for taking the time and giving us the latest market news and information as such. And for those of you who are attending, thank you for taking the time on your Saturday morning. We will be back with another session on the 22nd of November. So please keep an eye on your inbox. It's a very interesting topic that Sunil will be presenting to all of you to understand the psychology of the Indian investor as such. As new MFDs, I think this is one session that you should not be missing. Products and market will keep changing, but what stays constant is the psychology of your investors. So we'll go deep into how your investors will think, react, and make decisions, which in turn will affect the way you run your business as well. So thank you, Sunil. We look forward to your next session with us.
Thanks a lot, and wishing you all the best, everyone.
Thank you. Thank you.